it's just like the single family. How do you get deals on single family side? Well, there's motivated sellers out there, right? There's death, disease, divorce, disaster, like all those different things where price isn't the greatest motivation for them to sell. It's to get a headache, get a problem off their plate.
All right. Hi, everybody. This is Joseluiz Morales. Welcome back to the Morales Group Show. Today, we've got a very special guest. His name is Tim Bratz. He is the owner of Legacy Wealth Holdings. He's a real estate investor. His story is super inspiring. This is somebody who's young, doing big things. He owns a real estate portfolio in excess of 4,500 units and a value of $425 million. Welcome to the show, Tim. How are you?
What's up, buddy? Dude, great to be here, man. Thanks for having me.
Likewise. Thank you so much for taking the time. So I'm excited about this one just because, one, you're one of the younger people in the industry. And then two, you've been able to scale up fairly quickly from the time that you started doing this. So I'm excited to have you on the show and obviously to provide tons of value. So let's just start off by who is Tim Bratz and how did you get involved in real estate?
Yeah, man. Well, again, thanks for having me. Appreciate all the value you're always putting out there, dude. So you're doing a lot of amazing things and a great leader. So I appreciate you, bro.
Thank you.
Yeah, man. So I was going through college when the market was going crazy last time, 03 to 07. And I wanted to make money. That's what motivated me back then. So I graduated from college, moved out to New York City. I'm a blue collar kid from Cleveland, Ohio, right? I don't come from a silver spoon. Like my dad was a cop. My mom was a stay-at-home mom. Raised in a blue collar town with an average home sale price of, I don't know, $100,000, right? And so I didn't go to an Ivy League school, went to a good school and was always a hard worker and paid attention in class and stuff. And, so I moved out to New York City after college. My brother was living out there, right? It's not because, they wanted to make it to the big leagues or anything. It was just because I had a free place to live. And so I moved out to New York City and I'm hanging out with my brother. I get my real estate license and I brokered retail leases and office leases for a commercial little boutique brokerage in Manhattan. And, brokered, it took me 8 months to close the deal, brokered a small lease on a 400 square foot little retail space, and we signed a lease for $10,000 a month on a 12-year term. And so you start doing the math, and you're like, "Wow, this guy's going to make like $1.8 million over the next 12 years for doing something one time." And that's what really motivated me to become an investor and not a broker of real estate. And so I moved down to Charleston, South Carolina, just kind of on a whim, wanted better weather and lifestyle. And this is right when the market collapsed, 08. Right when the market collapsed, I showed up to the party. Everybody's running out the back door saying, "Run from real estate." I was like, "Damn, I just got here." And, it was a good spot because prices had come down so substantially, but it was like opposite of what's going on today. Back then it was deals everywhere and money nowhere. Today it's, money everywhere, deals nowhere. And so it was unique in that you still needed to creatively finance, creatively structure, kind of figure some of these things out in order to make a deal happen and problem solve, right? And so, I got involved in that, bought my first house on a credit card, fixed it up, got into wholesaling, got into flipping, got into turnkey single family flips, started building a small single family and like duplex portfolio, and bought my first apartment building in 2012 and just realized instantly that it had the scale, right? And the efficiencies and the economies and the economies of scale and all the things that I was looking for that met my goals, met my ambitions, met my long-term perception of real estate. And then, I just kind of stuck with that. And so did a little bit of that. And over the course of a few years, took on some partners, had to liquidate portfolios, had good things that happened, had bad things that happened. And, I know it looks like I grew my portfolio pretty rapidly in a short amount of time, but I can tell you I was, struggling and messing up and bad at real estate for 7 or 8 years before I got good about maybe 4 years ago,
Okay. So basically, you obviously went through a lot of the learning lessons that most people. So why did you transition from the residential aspect to the commercial aspect, or even the multi-unit aspect?
Yeah, man, I saw it as a better vehicle, right? Like we were talking offline, like, I mean, give you an example, right? If you and I are driving down the road, you're in a Ferrari and I'm in a Ford Pinto, right? And we race, who's going to win, right? You're going to win because you're in a Ferrari. If we stop at the red light and we swap cars, right? I get into the Ferrari, you get into the Ford Pinto, and we race, I'm going to beat you. And it's not because I'm a better driver. It's just I was in a better vehicle, right? And likewise, when you were in that Ferrari. And there's a little bit of, the jockey does matter a little bit in some capacities. But in most capacities, dude, it's the vehicle, right? It's the horse that wins the race, not necessarily the jockey. And I think commercial real estate is just a better vehicle. I don't care how good of an operator you are. I know some of the best operators in the entire country on the single family side, and they work a lot harder than I do, and they don't have maybe a fraction to show for what I have, And so I don't think I'm a better person or anything like that, or a better business person. I mean, they're probably way better at operations than I am. I'm just in a better vehicle.
And that was one of the things. I actually went to one of your seminars, and whenever you said that, it stood out, because obviously I'm in the residential side right now, and I've been little by little transitioning a little bit more into commercial. I bought a 25 unit in California. I bought an 11 unit, which is in California, which is pretty expensive.
That's really expensive, right?
And it was interesting because whenever I would flip like a single family residence, I almost felt like it was a waste of time, just because there wasn't enough meat on the bone. Mm-hmm. And the first time I did my 25 unit apartment, it was a $4 million deal. That was like the first time I actually felt like my time was being properly invested, but it was because the upside was a lot bigger. So can you take us through your first deal, what that looked like? And then what advice would you give to somebody maybe looking to do their first commercial deal? Like, what did the first apartment look like? How many doors was it? What was the purchase price? Did you end up selling it? Did you end up keeping it, refinancing it? And did you use your own money, or did you use somebody else's money as well?
Yeah. Great question. I always get asked about my first deal, but not necessarily my first apartment deal, which is probably pretty more substantial, even potentially. So, listen, man, there's two ways to get into apartments. And a lot of people think that I think there's a lot of misperceptions in people's heads about what they need to do, or how they need to prepare in order to get into commercial real estate and apartments. One misconception is I need to go stockpile a bunch of my own cash in order to then have the capital in order to deploy it into an apartment building. I own $400 million plus of property. I've only personally invested $125,000 of my own money. So guess what? Really? You can light that one on fire, that you do not need your own money in commercial real estate, right? Another one, it's all convoluted, it's all complex, it takes a lot of underwriting and all this other stuff. I can assure you it is easier to underwrite a 100-unit apartment building than it is to underwrite 100 single-family houses, right? You got one utility bill instead of 100. You got one tax bill instead of 100. You're looking at one set of financials instead of 100, right? Like you're going to looking at the same apartment 100 times versus 100 different custom homes with different layouts and different mechanicals and different everything else. So it's like, it's actually easier when you're comparing apples to apples, right? Is a 100-unit apartment building as easy as a single family house? No, but it's way easier than 100 single family houses, right? And so if you compare it apples to apples, it's just easier, right? There's a lot of language and a lot of verbiage that people are like, I need to learn all this stuff. It's just it's a tweak for the exact same thing on the single family side, right? Stabilized value is the same thing as after repair value, right? Cap rate is the same thing as return on investment for the most part. There's a lot of things like that, value add, fixer upper. It's the same thing, right? It's just, I come from the residential world. I don't have a degree from an Ivy League school. I didn't come from a family that owned a bunch of commercial real estate. I've never taken a class on it. I've never read a book on it. I just took my philosophies in single family and deployed those into multifamily. So I'll give you an example. My buying criteria is I need to be all in for around 65 to 70 cents on the dollar of the after repair value, right? And so like, if I said, hey, if it works for single family, it must work for multifamily. The BRRRR method, right? Buy, renovate, rent, refinance that was a method that people use a lot of times in single family. I just started using that in multifamily. And so it's not like it's not as complex and convoluted as I think we all make it up to be in our heads. And it's a lot easier to digest than you might think. So going back to my first deal, it was 2012, right? It's the lowest the prices ever were. And I couldn't mess up. And I bought an 8-unit apartment building. I went in, I bought it super cheap. I was all in with renovations for $10,000 per door, right? So like, it's hard to mess that up. And it was a C- kind of an area. It was all beat up, and I used private money to do it. So I bought it, and I was all in it for less than $100,000, and I just used $100,000 of private money in order to then buy it and renovate it and then operate it. And so I didn't really refinance it. I held on to it, which is private money, for about a year, maybe a year and a half, maybe 2 years. I don't even know. And ended up selling it for about double what I was into it for. And so, and they still got a pretty good deal on it, right? So I think a lot of people think they have to wait to go and get like a 100-unit apartment building before they can get involved in apartments. And I can tell you that, like, you're not going to get the respect from brokers, and you're not going to get a good look at the good deals if you don't already have a portfolio. So I think it's better, like what I tell my students whenever I coach and do my boot camps and stuff. I'm like, listen, go out and just get the momentum going. Right? If you can't raise money on an 8-unit, how are you going to do it on an 80-unit, let alone an 800-unit portfolio? Right? Like, go out and raise money, go out and source deals, build the balance sheet, buy a 24-unit, buy a 10-unit, buy a 16-unit, buy a 60-unit. And all of a sudden, you pick up your head after a year or two, let's call it, and you're like, oh man, I own 100 doors. Well, great. Now you can qualify to go buy a 100-unit apartment building. Right. And then all of a sudden, then you double your portfolio overnight. And that's when this compound effect really starts setting in, and the snowball just grows and grows and grows. And you get so much momentum that you couldn't stop it even if you tried. So, I think it's more important to have those little victories and have those little wins, because then it makes it easier to raise more money, because you got a deal to point to. Hey, it's not a big deal, but made money, structured it the exact same way on this, 8-unit over here. And then I'm going to do the same thing on this 18-unit over here. And so and then it gives you a little bit more confidence. You puff your chest out a little bit more, and you can talk to brokers in a more postured manner. You could talk to sellers in a more postured manner. You can talk to your private money lenders in a more postured manner, right? All because you already have some wins under your belt.
It's funny because I feel like when I bought the 25-unit, that did exactly that for me. Like brokers started calling me like, hey, look, we noticed that you bought this building. I'm like, yeah, I'm shopping more. But it almost gave me like that confidence of actually like doing my first big deal. And it was interesting because once I did the $4 million deal, I bought a $1.7 million deal, and that 1.7 didn't seem so big. The first one, I was nervous, man. Yeah. I was nervous as hell. So if I'm hearing you correctly, the main thing is obviously getting out there and doing deals, but also like getting rid of like the psychological like roadblocks that people have, like meaning like, I need all this money. Like the reality is you can raise money to do that. So the main important thing is learning how to find deals. And if you learn how to find deals, then essentially everything else will come into play. Just out of curiosity, on that first deal, did you end up exchanging it into a larger deal, or did you just end up cashing out on that first deal and kind of taking the proceeds on that one?
Yeah, so I had a partnership with like an exclusive partnership with a couple of guys that put up the money, and we just used cash for about until we bought about 140 doors. And then that partnership, we just saw different long-term plans, and we decided to liquidate everything about 3 years in. So we never really did. Well, I did a couple of 1031 exchanges with them, and we just kept on rolling the money forward into new deals. But that's because we didn't have partners. It was just, essentially 3 of us that just kept on buying up a bunch of properties just with their cash. I did all the work. And then every time we'd sell, we'd roll into something bigger. And just got to a point where, we had different visions, and we said, hey, let's liquidate. So in 2015, we liquidated about 140 doors that we picked up. And, I started on my own, and it was a really stressful time, actually. It was a little bit ugly of a breakup initially. And, they lawyered up, I lawyered up, and then we realized only the attorneys were going to get rich. And so we're like, let's just sit down and hash this out. And that's when we decided to liquidate. And, I've been on my own since like late 2015. So about 6 years. I've built this portfolio. And so it seems like I did a lot in 6 years, but the reality is, it took many years of, I started investing in 2009. So I was investing for, 6 years prior to that, before these past 6 years. And I got all the mess ups out of my system.
Can you tell us about your strategy, like a value add strategy? Because I'm imagining that the only way you're able to use other people's money, or not the only way, but one of the ways that you're able to buy such a large portfolio with only $120,000 of your own money, is that there has to be opportunity for you to increase the value of the asset enough where you can make it. Can you tell us about how the value add opportunity plays a role in the assets that you're buying, and how that benefits investors as well too, that you work with?
Yeah, absolutely. And if you take a look at single family, right? You buy a distressed single family house. It's all beat up. It's a motivated seller. It needs a bunch of TLC. And you go in, you renovate it. You put in a new kitchen, new bathroom, new fixtures, new paint, new flooring, landscaping, everything. And all of a sudden the value increases. And you've created, through sweat equity, a bunch of value in that property. Now, single family is valued based on the house down the street that just sold, and what, like, the comparable approach is what it's called. Multifamily and commercial real estate's all valued based on the income approach. So it's based on what is the income minus the expenses equals the net operating income. And then there's a multiple of that it will sell for in the market that you're in. So that multiple will change based on you being in California or Georgia or Ohio or Texas or wherever. But essentially it's very predictable based on income and expenses of what a building is going to be worth once it's stabilized, once you go through the value add process. Because you can run rents and figure out what the income is going to be based on just looking at rental comparables. And so you can look at what is the building across the street rent for, and are those units nicer or not as nice as what you're going to put into your building, and you could figure out what the income number is pretty easily. Then you could figure out the expenses by looking at the current expenses of the current seller, plugging in those numbers. And there's some other numbers. You can talk to the management company to figure out the management fee is going to be. Shop insurance around, actually get a quote before you ever buy the property. You can get, look at the actual utility bills and potentially see if you can save some money on those utility bills by putting in LED lights and low flow water fixtures and things like that. Property taxes is a pretty straightforward number. You can just look that up in the county auditor's website. So taxes, insurance, utilities, maintenance. I'm renovating everything. I'm putting on new roofs. I'm putting on, fixing the parking lots, making sure the mechanicals have at least 10 years of life. So that way I have very predictable maintenance schedule on an ongoing basis. So, you take the income, subtract out the expenses, it leaves you with a net operating income. And then based on, me investing in Georgia, I know that it'll appraise for around a 6% cap rate. So now I know exactly what that stabilized after repair value is. And then I back into the numbers the same way that I back into it from a single family standpoint, right? Hey, if I'm going to buy a house and it can sell for $200,000 and I need to be all in for 70%, okay, great. That means I have to be all in for $140 minus the renovation cost of $50,000, means my maximum allowable offer is $90,000. I do the exact same thing in apartments. I just add some zeros, right? If the building's going to be worth $10 million, I need to be all in for $7 million. It's going to cost me $1.5 to renovate it. So my maximum allowable offer is going to be $5.5 million, right? It's the exact same thing. It just value, like the after repair stabilized value is found in a different way based on the net operating income versus just some comparable approach of, what houses are selling for down the street.
So let me ask you this, like, what benefit would like an investor have? Like, let's say that I had money in the bank and I'm earning 0.00001% on my money. Like, why would I go invest with or what would be the benefit of maybe investing with you? Like how do you make it worthwhile for somebody to maybe to invest with you, to make it worth your while, or make it worth their while? And how are those deals typically structured, if possible?
So in that example that I gave you, $10 million building, I'm all into for $7 million. So let me back up for a second. What you need to realize is like there's usually two types of investment opportunities for passive lenders. One is a debt structure, which is like a hard money lender. Let me lend you money and you pay me 12% plus a couple points, or pay me 15% straight return on my investment. And it's if you get rich, they don't. If you lose money, they don't, right? So like it's very predictable cash flow, and that's great. The other type of option is an equity investment, meaning most commercial real estate deals are done more on an equity investment where somebody puts money in and they play in the upside. So if the property wins in a big way, they make a lot of money. If it doesn't, then they could lose all their money. But the limitation is that there's no predictable, consistent cash flow paid out. And I've realized that most investors want both. And so I've created just a hybrid to pay both. So I'll pay a fixed return on investment. Somebody invests $100,000 and I'll pay somewhere between 6 to 10% on their money while their money's invested. And because I'm doing these value add properties, I can create that appreciation in a fairly short amount of time. Let's call it 2 to 3 years. So I'm able to renovate it, stabilize it, refinance it in 24 months. And let's say the investor made 8% on their money in year one. They make another 8% on their money in year two, regardless of the property's performance. They're making 8% on their money. Then I refinance. They get all their money back. And then they keep a percentage of equity in the deal forever. And so that equity in the deal, on a $10 million building, if I'm all into it for $7 million and they get a percentage of that, that means there's $3 million of equity in the deal. So, obviously if you're holding on to it, they're not going to be able to pull that cash out because it's in the property, but that equity will yield a dividend. It will yield cash flow, right? And every month that the tenants pay their rent, it covers all the operating expenses, covers the debt service, and there's cash flow that gets distributed to me, any other joint venture partners, and my investors, even though they don't have any money invested anymore. They've gotten all their money off the table. So it's really it's free and an infinite return for them. Then they also get depreciation. Then they get appreciation as rents go up over the course of time. And they get principal pay down on the loan too. Every month we make a mortgage payment, we're paying down the principal amount. And then all of a sudden, 10 years later, that $3 million of equity is closer to like $8 million of equity. And then we sell it and they get a percentage at that time. That's probably going to be pretty close to $100,000, maybe $120,000, even though their money's not even involved anymore. So while their money's in, it's nice because they have a predictable cash flow. Then they get all their money back out, and then they have this nice little, almost like an annuity that just pays them cash flow every single month. And then when the property sells, they get these big pops of refinance proceeds or sales proceeds. So it's a pretty sweet deal for them, man.
Yeah. So essentially, the whole point is to find undervalued assets in the marketplace. You find the undervalued assets. You basically structure the deal in a way where it benefits all parties. You improve the income on the property, reduce the expenses. Therefore, you make the building worth more. And then from that point, basically, you can refinance, get most of their money back out, if not all of it. They still get a percentage in the deal. So it makes it a win-win. So my next question to you would be like, people are probably thinking, well, how do you find an asset that's 70 or 65% of the market? Like, why would somebody want to let go of a property like that? Like why would somebody want to let go of a property that far less than market value? So can you go over maybe like why somebody would sell a property at that price? And who's the ideal seller? Like, who are the typical sellers that are selling these properties for 65%, 70% of the value?
Yeah, man. And I think it's a great question. It's just like the single family. How do you get deals on single family side? Well, there's motivated sellers out there, right? There's death, disease, divorce, disaster, like all those different things where price isn't the greatest motivation for them to sell. It's to get a headache, get a problem off their plate. A lot of the properties, some of the properties I bought earlier on, most of the properties I bought earlier on were mom and pop investors. And they were just, they bought this apartment building. They had it for 20 or 30 years. They sucked all the cash flow out of it, never put any money back into the building. And then all of a sudden it comes to a point where it needs a bunch of money and they're not bankable and they don't have the cash. They don't have the capital to then infuse, and they're backed into a corner where they have to sell. So that's one person who I bought a lot of property from. Another, surprisingly, is really sharp entrepreneurs who make millions of dollars in whatever their traditional business is. And then they think, oh, listen, I drive by apartment buildings every day. Maybe I lived in an apartment building when I, was younger or whatever. And they're like, oh, if I know apartments, and real estate's passive, right? It's 100% passive type of an asset. You don't have to do anything. And then they take their money that they make in their traditional business and they deploy it into apartment buildings. And they think it really is passive. They don't think they have to do anything, right? Residual and passive are two very different things. Like residual means you do something once, you get paid on it over and over again. Passive means you don't do anything, right? Apartments are residual. Now you can layer it with passive management and asset management, but dude, you need to have your own team. Somebody needs to be paying attention to this thing. And they just don't, right? So they take their money, they dump it into an apartment. They don't have the experience. They don't have a joint venture partner. They don't have a boots on the ground partner. They didn't interview 5 different management companies, and they don't even know the right questions to ask or how to look at the reports to see if everything's checking out. If they're not, make sure they're not overpaying for landscaping or like, dude, I've had management companies that put like Christmas bonuses on my property for employees that didn't even work at my property, right? Like, what? Paying for computers for their employees out of my property expense report. And I'm like, what is this? And so some of these other entrepreneurs, they're making money in their other business. It's like starting a new business. It's like you and me sitting at a bar and saying, you know what, Jose, we should open a bar, dude. We drink in one. Let's just go and open one, right? And you're like, no, it's a little bit different to drink in a bar versus operate a bar.
Owning a bar.
And so there's a lot of entrepreneurs who are smart, who are very successful, who are very wealthy, who think it's a passive investment, just go and dump money into commercial real estate, and then they get their butt handed to them. And then a guy like me who actually knows what they're doing swoops in and buys it for pennies on the dollar, because essentially they're like, listen, I'm either going to lose this property or I'm going to lose the property and my business if I keep on taking my eye off the ball in my traditional business. So they end up just dumping the property at a deep discount and they go and focus on that. And then I'll give you one more is there's a lot of operators who just don't pay attention, meaning they don't look at the highest and best use of the property and the amenities and the space and the square footage and the property dimensions and everything. And so, like, again, it's very predictable what these properties are worth based on the rental income minus the operating expenses. There's a lot more ways to generate revenue and generate income than just rents. What if you put in laundry? What if you have storage units or storage lockers in the basement? What if you have off-street parking? What if you have covered parking? What if you actually have garages? What if you have a dog park? You put in a dog park and you don't make money from a dog park, but you know what you do make money on? The pet fees and the monthly increase of $25 to $50 a month per pet that comes in. And all of a sudden, these things incrementally add up over the course of months and a year, and all these little improvements, vending machines, there's a billion different things. You can go and negotiate a deal with your cable company and have them put cable in the entire building and internet in the entire building, and it might cost you $30 per unit per month, right? The tenants, if they went and signed up on their own, it'd be $150 per unit per month, right? And maybe you can bill it out to them at $80. So you're saving them money. That's a big win for them. And you're making an extra $50 per unit times 100 units. It's $5,000 a month, $60,000 a year, adds over $1 million of value to the property from doing that, right? So it might cost you 150 grand or 200 grand to have that invested. But guess what? It increases the value of the property by $1 million. So like there's things like that you can do that create significant improvements on the income that people just don't pay attention to. And to that extent, I just bought 550 units in Houston, Texas. And a lot of people were looking at that deal and they're like, yeah, it's good. It's not a great deal though. It's like barely a base hit. You could be all in for 70 million and it's worth 85 million or something like that. Or 72 million and it's worth 85 million. my team goes in and realized that it had a disproportionate number of 3-bedroom units, and there was like 51 bedrooms, 202 bedrooms, and 303 bedrooms. And you're like, dude, that's way too many 3 bedrooms for an apartment complex. And we realized the layout could be cut in half and create 2 1-bedroom apartments. So because there were so many 3 bedrooms, they were getting pretty much the same as what you could get for a 1 or 2 bedroom. Like it was like $200 a month more. And instead, I was able to double the number of units. Instead of getting, let's call it $1,300 a month in rent, now we're able to get $2,000 or $2,100 a month in rent. We're making $800 more times 100 units. What is that? $80,000 more a month, which over the course of a year is $1 million over the course of a year, which increased the value of the property by, I don't know, let's call it $18 million from doing that. And it cost us about, I don't know, a couple $1 million in order to split those up. But it's something that we saw that other people didn't see on how to increase the income of the property and utilizing the space that we already have. Does that make sense?
It makes 100% sense. So it's just kind of finding people that are your mom and pop people, or even the people that make a lot of money and think that they could run an apartment complex, or even seeing value where other people don't see it. In California, there's an accessory dwelling unit law. What that means is that you can convert garages or storage into additional units. So on my 25-unit building, I'm actually improving the value by adding 9 additional units through the ADU law. So I'm getting a 20-unit building, making it a 34-unit building. Perfect. And that's one of the ways that we're adding value. But it's the same thing as your Texas deal, that when you're seeing value, some people are thinking, man, this asset is overvalued, or this asset is an okay deal. But then if you structure it a different way, now you can turn an okay deal into like a huge moneymaker. And I'm imagining that that's more important now, where there's a lot of money being thrown at deals. That actually helps you a lot now, because it allows you to maybe see something that other people don't see and be able to justify it. So here's one of the things that I have. All of my units are invested in Southern California, every single one of them. And the reason they are is because I feel extremely comfortable for that. If somebody eventually, like me, wanted to go outside of California, do I just pick any market? Like, can I go to Detroit, Michigan and make as much money as somewhere else? Or how would I go about selecting the right market? And what should I look for, basically? It may be in regard to population, jobs as well, too. Like, is there anything that plays a factor there?
Yeah, man, great question. I get that a lot from California people, too.
I know.
They're like, oh, I can't invest in California. And I'm a believer that there's acres of diamonds in your own backyard, right? Like, I think that I think the best place to start is in your own backyard, assuming you understand the municipal laws, how to underwrite it, the nuances of the court system, the nuances of the building department, the nuances of the housing laws and landlord-tenant regulations and all that stuff. So, like, I'm a big believer in just doing deals in your own backyard and starting out that way. Are there greener pastures? I don't know, maybe. Like, I invest heavily in the Southeast because of a few reasons. It's very landlord friendly versus tenant friendly in a lot of the Northeast, or maybe the out West on the coast. So I like landlord friendly areas. It makes it a little bit easier to do business. And if a tenant doesn't pay, or if a tenant has drugs, or if a tenant's not respectful to the other tenants, and we need to kick them out, it's a little bit easier to go through that process and faster to go through that process. So that's one reason. Another reason I invest more in the South is because it doesn't get beat up by the snow and the ice and the freezing temperatures that like a Cleveland, Ohio does. Dude, I vividly remember freezing temperatures, negative 20 degrees in Cleveland, Ohio for almost a week straight back in 2013 going into 14. And all the plumbing, and like we have boiler systems out in Cleveland. So it's one central heating system, which is another issue because that's all on the landlord, right? I don't have that down in Georgia. Like, everything's like centrally, it's all central HVAC, tenants pay all that stuff, and I don't have to deal with it. So up in Ohio, I have to handle all that kind of stuff. I'm paying the utility bills, and the pipes froze that one time. So and it only happened on a Saturday night at 10 o'clock. So now I'm going to Walmart buying space heaters and taking them over to the property. And it's just in the middle of the night, in the middle of the freezing cold, delivering it to tenants. And it was horrible. You don't deal with that in Georgia. You can work on the properties year round down in the South, versus in Ohio, you can only do exterior work about 6, 7, 8 months out of the year. The other 4 months, your kind of hands are tied. You got to wait. So, there's a lot of things like that where I think there are maybe some benefits to certain markets. But I think there's deals in everybody's market. If you're looking at new markets, I would look for actual markets where somebody that you feel confident and comfortable kind of joint venturing with. Somebody who knows what they're doing, somebody who can go and source deals locally, who can operate those deals, who can keep the contractors honest locally, who can go and put their eyes on it to keep the management company honest, kind of act as a boots on the ground type person. So I'm in 12 different states, and I invest in those different states based on who I know and who brings me a deal in those markets. And if I like that operator and I feel confident in their ability, I will go and buy in that marketplace. And as long as they're have an equitable interest in the deal to make sure that it gets performing. So I would look at that. And then from like a demographic standpoint, dude, there's markets that are growing. There's markets that are stagnant. There's markets that are declining. I don't necessarily look at some of those things maybe as in depth as other people do. What I look for is really good school system, or like a decent, respectable school system, a safe place where people can walk around and not have to worry about getting mugged or robbed or any garbage like that. The kids can run around and ride their bikes on, down the sidewalk. And then I look for some sort of economic anchor, something that, is big business or like government jobs or military base or higher education of some sort. That's like an anchor to the community, hospital, that creates a bunch of jobs there. And then there's all these ancillary businesses around it that stimulate the economy, the local economy. So if it has those three things, I don't really care if the population is increasing, decreasing, or staying steady. I know that if I can then go and take a look at if I get a good deal on an apartment building and I can renovate it and I can have the nicest units in town and I can at least match or beat the price of across the street and whoever's offering those units, I know I'm going to attract the best quality tenants in that marketplace, and then my occupancy is going to stay high. And they're not going to leave. They're not going to go somewhere else. They're going to stay in that unit longer because there's nothing nicer and offering as much value for the price point. So that's more my philosophy. I know some people are like very data driven and analytical on some of that stuff, and that's okay. I don't know. I don't get caught up in that. I just want the nicest building, the nicest units in an area for the lowest price point. And naturally, all those other tenants who leave those other buildings are going to be coming to my building.
Sometimes it paralyzes you to be so to look at too many different data points. You've got so much information that it gets you scared to even do anything, and you don't end up doing anything. So you mentioned on one thing, which is kind of having operators in different areas in different parts of town. How important is the management on an apartment complex? Is I'm getting the feeling, or I know that the manager is probably one of the most important things. And who are the different players in a team or your team that help you run a portfolio like this?
Yeah, man. There's three things that matter in us doing deals. One is finding deals. 2 is raising money. 3 is operations, right? Everybody thinks, hey, if I can find a deal and raise money, I can take deals down. Yeah, but that doesn't mean you can keep them, right? Now that's when the real work begins, is once you buy the deal and you have to operate it. And I think there's going to be a lot of stuff coming online because people can raise money because money's easy to raise, right? And maybe they found a deal, but that doesn't mean that they can operate them. And I think there's going to be some deals, coming online from people who jumped into multifamily and didn't really have the education or the experience to get in that asset class.
I'll tell you this, Tim, when the market is good, everything works.
Yeah.
But whenever, for example, I remember when the pandemic started, I remember you were one of the very first people that was all involved in the tenant laws. And I didn't raise rents on any of my properties during the eviction moratorium. I didn't want to give anybody any reasons not to pay the rent. And all of that, the management team has a lot to do with that. And you were very proactive about it. You were posting stuff online right away. So who would be the key players, or who would be the different players that you would say that would make up a solid operations team?
Sure. So let's assume you have a 100-unit apartment building. Once you get over, and I'm using like unit numbers because it's easier to quantify, but really on your 24-unit in California, your rents are enough to probably substantiate an on-site property manager. In the markets that I buy in, there's secondary markets in, South Carolina, Georgia, Louisiana, Alabama. I have stuff in Mississippi. I have stuff in North Carolina. So but they're secondary kind of markets. So my average rent is somewhere between $700 to $1,200, depending on the property. For that size rent, I need at least like 70 to 100 units in order to justify on-site property management. So let's assume I'm going to have a 100-unit building. That 100-unit building typically has 4 people that work at the building. About 2 maintenance guys for every 100 units, 1 part-time leasing agent, and then a full-time property manager. That's their on-site, on-salary, working for the building. Then I layer that with a third-party property management company because they don't really have to do much other than just watch the personnel who are at the property, put reports together, handle bill pay, accounts receivable, accounts payable, that kind of stuff. They only charge me a 3% management fee. That's it. Because I have salaries. Then I have management, right? And then at my office, in my headquarters, somebody who's on my payroll, I have a COO or a director of asset management. You can have whoever you need, but you really just need one person who's actively asking questions all the time to the management company. And he hops on a call once a week with everybody for every property we own. So he'll hop on a call and say, hey, let's go through the metrics. And the property manager will give their metrics. The maintenance staff will give their metrics. The leasing agent will give their metrics. The property management company will answer any sort of questions and metrics that they have. And they just make sure everybody's on the same page every single week. And it's a 15-minute call at most. And then, we review the reports either on a weekly or monthly basis, depending on how often they come out, and just ask questions about it. If you're not paying attention to your property, guess what? Neither are they. So you got to make sure you're asking questions and putting your eyes on the property. If it's local, you should go and put your eyes on it at least once or twice a month. And if it's not you, it needs to be somebody reliable and somebody responsible that can go and, my COO or my boots on the ground partner or joint venture partner of some sort that can just keep everybody honest, right? If they can go out there and check out the property, that's keeps everybody else honest. Like, oh, the owner showed up and they're doing a surprise visit. Like that keeps the trash off the ground. It keeps the lights on. It keeps everybody from sleeping at their desk and all that stuff. So, just doing things like that are a little bit more proactive. I mean, it's an asset, right? It's worth millions of dollars. What are you going to sleep on it? Like, no, man, this is an asset that can make you or can break you. Because just as quickly as you can build wealth with apartments, you can also get wiped out from one bad deal. You can wipe out the profits of 5 good ones. So you got to just keep doing good deals and pay attention to those deals.
Yeah, I agree with you. I think that when the market is good, everybody does well, and then when the market goes bad, it really shows who doesn't have their pants on, right? But I wanted to ask you,
a good market will hide a lot of mistakes, Yeah. And a bad market will expose you. So just be ready.
What are the different metrics that you guys would look at? Do you guys look at vacancies or what would be the most, maybe the top 3 most important metrics that your operations people go over in a report?
Yeah, I mean, most important is collections. Just because it's occupied doesn't mean it's economically occupied, right? Just because it's physically occupied does not mean it's economically occupied, meaning tenants are actually paying rent. So the most important one, bar none, is collections. That's something we're definitely paying attention to. And from a leasing perspective, you can't really dictate how many leases you're going to sign, but you can dictate essentially how many open houses you host, right? And how many people you reach out to about the property. And so it's like closing deals, right? I want to close 10 deals a month on the single family side and flip 10 houses a month. You can't really control that. What you can control is how many offers you make. And then eventually, once you make enough offers, a ratio will appear that if you make 100 offers, 4 deals close, right? So next month, if I want to close 10 deals, I need to make 250 offers in order to close 10 deals. And so that's the same thing with leasing, right? It's prospecting. It's going out there and laying the groundwork, doing the the legwork in order to have people coming in. It's exposure, it's marketing, and how many open houses, how many showings. Like that's really the number that we're paying attention on the leasing side of things. And then on property management, we're talking about collections. On project management, we're looking at days to turn over a unit. From the time it goes vacant to the time that it comes back online and is occupiable, what does that timeline look like? We're looking at a bunch of different metrics depending on the role of the individual.
And how is your team different than when you were originally starting? Like when you originally started, I'm imagining that you didn't have the COO. Was it just Tim Bratz doing everything at that point?
Yeah, Tim Bratz, COO, CEO, bookkeeper, right? Maintenance guy, property manager, maintenance phone call hotline, right? Like I was doing everything. I acquired the deals. I project managed the deals. I swung the hammer a lot of times. I, sprayed for bugs. Like I did literally everything for the first 6 years that I was in business. I didn't really hire somebody until 2015 to be my executive assistant. And so I hired somebody because I was burning the candle at both ends. I needed somebody to take those like non-revenue generating activities off my plate so I could focus on making money. And dude, that changed everything. I tripled my income, my net income in 2015 because of that. And then I just, but then you go down this road of like over hiring because you think you just hire out every single problem, and then you don't train and you don't measure their performance. And then all of a sudden you realize businesses go out of business because of lack of cash flow, which comes from having too much overhead, which comes from having too much staff. And so, I went down that road too in 2016 and had to fire everybody and start all over again and all sorts of stuff. So, I realized that people are assets if they're trained properly. Well, first of all, they're screened properly, and then they're trained properly, and then measured properly. You got to do those three things.
Yeah, and it's interesting because you run into different problems at different levels. Like your first problem was getting like some help. Then when you got the help, it was like I've got too much help now. Now my business just went not as profitable. Then different sets of problems and different sets of problems. So one of the things that I believe in a lot, Tim, is having mentorship in my life and having people that maybe have been down that road, or maybe just somebody that has a different set of eyes that can almost look at that and be like, hey, look, it's not that complicated. Do this, this, and this, and you're back right on the line. So have you done any coaching? Or are you involved in any mastermind groups? And if so, like how important has that been in your career? And how much would you say that you've invested over like your real estate career in either consultants, masterminds, and that sorts of thing? Because I think this is really important. I think that this is where a lot of people miss the boat sometimes.
Yeah, absolutely. And I think the mindset and the access to resources is 80% of this game. You're going to pay for it one way or another. You're going to get the education one way or another. You're either going to lose money in doing deals and it's going to take a lot of time, or you're going to pay to be in the right rooms with the right people who can impart their knowledge on you, help you fast track your success. And I promise you, if you just pay for being in the right rooms and being in a mastermind, it's a lot cheaper and it's a lot faster to have success. If you're going to go do it the slow way or the hard way, it's going to be painful. It's going to be expensive. It's going to take a long time, right? I'd rather just pay the money. And dude, it's a hard pill to swallow. I went out to my first mastermind in 2015, which is when my business exploded. And I don't think it's
by chance.
Yeah, I don't think it's by chance at all. And so, when I went out to that, I made $130,000 the year before. They told me I had to hire somebody as an assistant and join their mastermind for $30,000. So it was like hiring an assistant was like $35,000-$40,000. Joining their mastermind was another $30,000. It was like $65,000. I only made $130,000 the year before, so they took half of my money away from me. And then I made $400,000 because I had an assistant and because I joined a mastermind. Because like you said, every level there's another level of problem. So you don't just go out to one event. You got to be plugged in to a network of people who know you, and you feel comfortable sharing your circumstances with. And every 90 days gives you a nugget to then go and implement in your business, and then take you to that next level, and then experience the next level of problems and struggles that come with it. And then there's another event every 90 days, right? And so now you have another punch through past that problem, and it just quantum leaps forward, on and on and on. And that's how I experienced so much growth. So, dude, to answer your question, I spend over $100,000 a year on different masterminds. I'm in 5 different masterminds, and I don't go to all of them. Some of them are for my team. Some of them are virtual. Some of them are like e-commerce. Some of them are single family real estate where we get some strategies and techniques and ideas. Some of them are multifamily real estate where we get some great connections. Some of them are for my team, and maybe I'll go once a year. Some of them are for me, and it's like marketing or whatever. So I'm in 5 different masterminds, and then I run 2 masterminds, a virtual kind of mastermind, and then a kind of a high level like business development type mastermind.
It's funny because I was the same way when I got involved in coaching. It was a lot of money back then, but I look at it now and it's insignificant in comparison to what it's made me. And I don't know if you know.
Go ahead. Sorry, didn't mean to interrupt.
I was going to say, I don't know if you know this, but I was accepted to Collective Genius as well too. So I'll be attending next week.
Congrats!
But that was the first time I dropped $25,000 on one thing, and that was like just me saying, okay, I've been stuck at a certain level. Time to take it to the next level. Like I'm in a room with people like you now, and it's like I'm probably the dumbest person in the room, and I'm okay with that,
What you want.
because obviously, like it'll give me exposure to people that are doing different things. But thank you for that, man. I really appreciate that. You were gonna say something before.
Yeah, I was gonna say like, all right, 25,000, dude. Not batting an eye, like not discounting how much money that is, right? I'm a blue collar kid from Cleveland, Ohio. You could buy, a quarter of a house, right, with that much money, and you're like, hey, maybe I should go buy a house instead, and maybe I'll get, I'll that's a better investment. Or what if you go and invest 25 grand into your education, and they show you how to go and buy 100 houses or a 100-unit building with that 20 without using any of your own money, but because you invested in yourself, I'm telling you, man, it is the best return on investment you could possibly find. And when I think about 25 grand, you know what I think about? What would it cost to have this board of directors around me for my business? Hundreds of thousands of dollars, if not millions of dollars, to get the insights and connection to resources and access to capital and access to marketing knowledge and access to just industry knowledge and experience that you can't even quantify it. And so I'm like, dude, it's $2 grand a month, right? It's $2,000. If you think about it, it's $2 grand a month for a board of advisors, board of directors of all millionaires and decamillionaires. And there's some people in that group that are worth hundreds of millions of dollars, right? Like you cannot pay for that outside and see that kind of return for the less than the cost of what an executive assistant or a personal assistant would cost you. I think it's hands down the best investment you can possibly make. And I attribute a lot of my growth to being in masterminds.
Yeah, same here. A buddy of mine gave me an example a long time ago where it was you can invest $2,000 into like a property or this or a month in a property or this or that, or you can invest it in yourself or invest it in your business. And that return right there is exponential right there. It's huge. Good. Is there anything else that that we might have missed, Tim, that you think would add value to the audience, or that you think would be helpful to maybe somebody looking to get started in multi-unit investment? And then we'll get into how people find you at the end as well.
Yeah, man. I mean, hey, I think you and I can sit here and talk all day, right? Like we just enjoy the conversation. We like talking to each other, and I think we have very similar mindsets. And I think we can keep this rolling for hours and hours and hours. But I think having a solid strategy, realizing that the market's really, really hot right now. People get emotional when they get into bidding wars, and they don't think logically or reasonably. And realizing that commercial real estate is a dollars and cents business, right? It doesn't matter. Don't get into a bidding war. If the numbers make sense, then you can do the deal. If it does not, then guess what? You walk away from the deal. You have a maximum allowable offer, and you do not go over that. So it's non-emotional, strictly down to the dollars and cents. And then understanding that, like, why did a lot of people go out of business in 2008, 2009, right? Like, and I structure my business in a way to make sure that I mean, dude, you probably remember 10, 12, 13 years ago, people were tens of millions of dollars, and some of them went bankrupt, and some of them kept their head afloat and made tens of millions of dollars more, if not hundreds of millions of dollars more. And like, what was the difference between those people? Well, one of them bought for a wholesale price, the other one paid retail, right? Another one forced appreciation, the other one speculated on appreciation. And then there's people who bought for cash flow and people who didn't have any cash flow on their properties. People who bought in C-class or luxury areas, that those have big swings, right? Versus people who bought in kind of blue collar workforce housing areas that pretty insulated, right? When the market's good, everybody can afford that. When the market shifts, a lot of those luxury renters move into more of a workforce type housing space. I think things like that, people who force the deal to happen versus people who try to kill deals. When you try to kill a deal and you can't kill it, that's when you know it's a good deal, right? Not by playing with the numbers and being like, oh, well, I can get $750 in rent, but how do the numbers look if I get $770 in rent? And let me give that to the investors instead. Dude, that's not the right play. If I can get $750 in rent, I'm underwriting it with $700 a month in rent. And I'm trying to kill the deal by stress testing the numbers so much that, essentially it doesn't shake out and I have to walk away. And guess what? If I stress test it and it still works, that's when you know it's a really good deal, because even if the market collapses, this thing will still cash flow and it'll still make money and you're still in good shape. So, I think having some understanding of some of those parallels of what to do versus what not to do, and understanding this isn't a get rich quick, but it is a build wealth, build legacy slow kind of a business.
For sure.
You got to have a long-term vision on it.
Absolutely, man. Good. Where can people find you? I know that you do some coaching as well too. You've got a couple of programs. Feel free to plug those in as well too. And if somebody liked the information, where could somebody get a hold of you?
Yeah, man. I'm really, so first of all, thank you. And that's not why I'm here, is to plug any of that stuff, but I appreciate it. I just want to, dude, I'm a big believer that wealth is like sunshine, right? Like other people getting sunshine takes no sunshine away from me. And I think there is more than enough wealth to go around for all of us. So that's really like the mission of me plugging in. But I do some coaching, right? I'm very active. I put out a ton of social media, a ton of content on Facebook and LinkedIn and Instagram and TikTok and YouTube, right? So just come and find me on Facebook and Instagram. That's where I'm most active. And then we have a YouTube channel called Legacy Wealth. You can check that out too. Ton of free content there. And if you're looking for something more formal, like more step-by-step process on how to buy apartments and how to scale up into finding deals, underwriting deals, raising private money, structuring it with financing, and then operating apartment buildings, I host a boot camp called Commercial Empire. It's virtual. I do it a few times a year. And actually, yeah, I mean, you came out to the live event.
Yeah.
And so we've gone virtual since COVID hit, but and dropped the price. Sorry, dude. I know you paid $5,000 for it, but it's only $500 now.
It was worth every penny, man.
It is. Right?
It's worth every penny.
It's a super valuable, and I appreciate you saying that. It's we put a lot of time and a lot of effort and a lot of thought into making sure that we're giving as much value as humanly possible. And I don't have like upsells or anything. I got the mastermind. That's the only other thing that I have. But it's just a good introduction to commercial real estate and apartment building. And yeah, that's commercialempire.com if you're interested in that. So I appreciate you, brother, dude. Excited that you joined CG. It's a great group of guys. I actually can't make it. I actually have my own event next week. I was bonehead and double booked it, but yeah, I mean, you're gonna have a great time there. You're gonna meet some amazing people, and it's gonna open you up and it'll help you level up. These masterminds are unbelievable. There's so many good ones out there, and you just find one that you really, the core values align, and then join. And the other thing that I would say is don't join for a year and be like in a transactional mindset. I would join with at least the mindset of a 3-year commitment, because that first year is just kind of getting to know everybody. Year 2 is you cultivate those relationships. Year 3 is when really the harvest starts coming.
Yeah, I'm in it for the long run, to be honest. I was looking for something like this, and just so you know, my experience, the onboarding process is so amazing. Like, meaning just everything is so systemized. But if you think about it from a business perspective, that's how you should treat your business as well too, like meaning like with your clients, whenever they get onboarded as new clients or new properties. I mean, they assigned an ambassador to me for the first day, and I'm just like, man, these systems are so on point, which is what I love about it. The only other advice that I would give to the audience out there is, if you're going to get mentored, find somebody who has already been through somewhat of what you're going through. Like, for example, like if you're looking to get into multi-unit, I can say Tim is a guy that has been through it, from buying small apartments to now buying hundreds of millions of dollars in apartments. So he would be a good person to go with, just because obviously he's been through that road and can guide you guys. But that would be my only advice to the audience. Don't look at it as a cost. Look at it as an investment. It's not an expense. This is actually something that will help you. I bought other apartments, and my goal, just so you know, Tim, so I think we'll get connected more, is I'm going to get more into the multi-unit space. That's my goal. Obviously, I've come from the residential, but I just feel that that can help me accomplish everything that I want a lot faster. And I just wanted to try it out in my backyard first to kind of see, just learn it first, and then kind of before I expand out.
Love it.
But yeah, man. Thank you, everybody. This is episode number 64 of the Morales Group Show. We had Tim Bratz, $425 million real estate man. Thanks, and we'll stay in contact, Tim. I appreciate you, and thanks so much for coming on.
Appreciate you, brother. Thank you so much for having me.
Likewise.